There is a particular kind of American, disciplined, skeptical of institutions, and possessed of what one might charitably call a foundational distrust of the Federal Reserve, who over the past decade or more has been quietly accumulating physical silver, not as a get-rich-quick speculation, not as a gambler's bet, but as a studied, sober, almost philosophical act of self-preservation. These are people who read the inflation data before their neighbors did, who noticed, years before the political class acknowledged it, that the purchasing power of the dollar was being methodically hollowed out, who understood, in that instinctive way that precedes formal economic education, that a government with unlimited printing capacity and unlimited appetite for debt cannot indefinitely protect the value of the paper it issues, and so they bought silver, they stacked it, they stored it, and in the fullness of time, they were correct. Consider, if you will, where silver stands today. As of this Monday, June 22, 2026, silver is trading at approximately $66.42 per troy ounce, a figure that would have seemed, to even the most optimistic stacker 5 years ago, like the arithmetic of a fever dream. The metal hit an all-time nominal high of $121.67 just 5 months ago, on January 29th of this year, before pulling back in the turbulence that has accompanied the Federal Reserve's renewed hawkishness and the geopolitical theater of U.S.-Iran negotiations in Switzerland. A year ago, silver was trading closer to $36 per ounce. That means the patient, disciplined American who held through the volatility has seen gains approaching or exceeding 84% in 12 months. Gains, one must pause to note, that the IRS has been patiently, methodically, and entirely legally waiting to tax. This is the part they did not tell you at the coin show. This is the part the YouTube video about dollar collapse did not mention. And this is the part that is going to cost a great many silver stackers, many of them retirees of modest means who accumulated their ounces slowly and carefully over years, a sum of money they did not budget for, did not anticipate, and, most painfully, did not have to lose, had they simply known the rules before they sold. Here is the foundational fact, and it must be stated plainly because the confusion surrounding it is remarkable in its breadth. Physical silver is not treated by the Internal Revenue Service the way most of its owners assume it is treated. Most investors in America, conditioned by decades of experience with stocks and mutual funds, assume that any asset held longer than 1 year qualifies for the standard long-term capital gains rate, AS, 15% for the typical earner, 20% for higher incomes. That is the number they do their mental arithmetic with. That is the number they subtract from their gains when they calculate how much they will walk away with. It is the wrong number. The IRS classifies physical silver, along with physical gold, physical platinum, and physical palladium, as a collectible. That is the precise statutory language. A collectible. The same category that governs fine art, antiques, rare coins, and vintage wine. And collectibles carry their own maximum federal long-term capital gains rate, one that has existed in the tax code for years, but remains astonishingly, almost entirely unknown to the people it most directly affects. That rate is 28%, not 15, not 20, 28. For the stacker who bought silver at $18 per ounce several years ago and is selling today near $66, the gain per ounce is approximately $48. The tax on that gain, at the collectibles rate, is $13.44 per ounce. On a 500-ounce stack, that is $6,720 in federal tax before the conversation has even turned to state obligations, Medicare surcharges, or the cost basis traps that await the unprepared. There is, to be fair, a nuance here that offers partial relief to some. The 28% is the ceiling, not an automatic floor. If a taxpayer's ordinary income rate is genuinely below 28%, they pay the lower rate. But here is the mechanism by which that consolation so often evaporates. Silver gains are added to a taxpayer's total income for the year. A single large silver sale can push someone from a lower bracket directly into the 28% zone. The sale itself manufactures the income that triggers the higher rate. The trap is self-sealing, and for those who held their silver for 1 year or less, the situation becomes even more punishing. Short-term gains on collectibles are taxed as ordinary income, potentially at rates of 22, 24, 32, or even 37%. Depending on the taxpayer's income. Selling recently purchased silver is, from a tax efficiency standpoint, one of the more expensive voluntary acts an American can perform, and the IRS will not interrupt the transaction to explain this. The government, after all, has no statutory obligation to warn you before collecting what it considers its share. If the collectibles rate were the whole story, it would be troubling enough. But the whole story has layers, and each layer, upon examination, reveals something important about the distance between what silver stackers believe they understand and what the tax code actually says. The year 2026 has added two specific developments that every person holding physical precious metals must understand, and the odds that most of them do are, based on all available evidence, not encouraging. The first development is federal, and it arrived with almost no fanfare whatsoever. On February 10th of this year, the IRS revised the instructions for Form 1099-B, the document that precious metals dealers use to report sales to the government. The revision removed what had been a certain ambiguity in how those instructions address the aggregation of multiple sales. The updated language is, in its way, a marvel of bureaucratic directness. Sales to a single customer during a 24-hour period must be aggregated and treated as a single sale when determining whether a reporting exception applies. What this means in practice is that the strategy of breaking a large silver sale into smaller, staggered transactions to remain beneath a reporting threshold, a strategy some stackers had been employing with what they imagined was some sophistication, has been anticipated and foreclosed. The IRS looks at the substance of what you are doing, not merely the mechanics of how you are doing it. They wrote this rule to address exactly that maneuver. They are not surprised by it. They designed the response to it. It is important to understand, however, that dealer reporting thresholds and personal tax liability are entirely separate matters. The absence of a 1099-B does not reduce what you owe. The IRS has been consistent on this point for years. No form does not mean no tax. Your gain is your gain regardless of whether a piece of paper traveled from a dealer to a government processing center documenting it. This distinction matters because some stackers have operated under the comfortable armor, an entirely incorrect assumption that staying beneath a reporting threshold was the same as avoiding tax exposure. It is not. It never was. The second 2026 development is at the state level, and it represents a shift in policy that Washington State, a jurisdiction not typically associated with hostility to financial planning, has executed with what one must admit is a certain administrative completeness. On January 1st of this year, Washington eliminated a precious metals sales tax exemption that had been in place since 1985. For 4 decades, Washington residents could purchase physical silver and gold without paying state sales tax on those transactions. That exemption is gone. Buyers in Washington State now pay the full retail sales tax on every ounce of silver they acquire. Depending on county, that combined rate ranges from 6.5% to 10.3%. In Seattle, the upper bound applies. A Washington stacker purchasing $10,000 in silver at today's price of approximately $66 per ounce is now paying up to $1,030 in sales tax on the front end of the transaction before a single cent of gain has materialized, before the federal rate has been considered, and before a single ounce has left the dealer's case. Washington is not an isolated case. Maryland taxes all bullion at 6%. Vermont applies 6% at purchase and then taxes gains on top of that, the compounding of indignities that characterizes double-hit tax structures. Maine applies 5.5%. Hawaii applies its general excise tax of 4% or more with no exemption for bullion whatsoever. California exempts purchases above $2,000, which means the small stacker who buys a few ounces at a time pays sales tax on every visit to every dealer in the state. And the legislative direction of travel is not difficult to read. Washington's decision is being watched by every state treasury department in the nation. Now, if you are among those who believe you understand the outlines of this situation, permit me to introduce what is perhaps the cruelest and most temporally disorienting element of the silver tax landscape in 2026, the Medicare Income-Related Monthly Adjustment Amount, known by the acronym IRMAA, which could scarcely be more aptly named for an unwelcome visitor who arrives without invitation and stays well past the point when you would like her to leave. IRMAA is the mechanism by which Medicare increases Part B and Part D premiums when a beneficiary's income exceeds certain thresholds. The 2026 standard Part B premium, for context, is $202.90 per month. For most retirees on fixed incomes, this is a number they have budgeted around with some precision. What IRMAA does is introduce a surcharge when your modified adjusted gross income crosses specific levels. For single filers, the 2026 IRMAA threshold begins at $109,000. For married couples filing jointly, it begins at $218,000. Here is the temporal cruelty of the mechanism. Medicare looks at your income from 2 years prior when setting your current premiums. That means a large silver sale made in 2026, one that pushes your income over the IRMAA threshold, does not merely increase your taxes in April of next year. It raises your Medicare premiums in 2028, 2 years after the sale that caused it, by which point most people have long since spent the proceeds and have no memory of the transaction that set the surcharge in motion. The 2026 IRMAA surcharges range from $1,148 to $6,936 per person annually at the upper income levels. A married couple, both on Medicare, who sell a substantial silver position this year and cross the joint threshold of $218,000 in combined income could be looking at over $13,000 in additional Medicare premiums arriving 2 years from now on a statement that will offer no explanation, no footnote, and no connection whatsoever to the silver stack they liquidated in 2026. If you have been watching this video and feeling something uncomfortable, something between concern and irritation, let me suggest that you do something rather important right now. Subscribe to this channel because what I am describing here is not a one-time phenomenon. These rules change, thresholds adjust, state legislatures move, and the people who arrive late to this information, as the stacker I am about to describe, discovered at very considerable personal cost, pay a premium for their tardiness that no amount of hindsight will recover. Subscribing takes 3 seconds. The information it delivers could save you thousands. Let me describe, with some specificity, what ignorance of these rules costs in human terms. A retired man, 12 years of stacking, done the right way, a little at a time, eagles and generic rounds in 10-ounce bars from a rotating cast of dealers, some purchased at coin shows with cash, some ordered online, some gifted to himself at Christmas over a decade of patient accumulation. By the time silver ran through its extraordinary 2025-2026 rally, this man was sitting on a position worth approximately $130,000 at current prices. He decided, reasonably, prudently, after much deliberation, to take some profit. He sold a portion. He expected a tax bill. He is not naive. He knew gains were taxable. He estimated something in the neighborhood of $15,000 to $18,000, budgeted accordingly, and felt, as one does after a decade of disciplined saving, rather good about himself. His actual tax bill was $29,000. The gap between expectation and reality was produced by 3 compounding factors, each of which was entirely avoidable, and none of which anyone warned him about. First, his silver gains pushed his total income for the year into the 28% collectibles bracket. The sale created the income that triggered the rate. Second, he had no documentation for a significant portion of metal purchased at coin shows and through smaller dealers years ago. Without records, his tax preparer, a generalist with no particular experience in precious metals, was required to use a conservative cost basis estimate. The actual purchase prices he remembered paying could not be proven. An unprovable basis is, from the IRS's perspective, no basis at all. In the absence of documentation, more of the sale proceeds became taxable gain than the economic reality warranted. And third, the income from the sale pushed him past the IRMAA threshold, which means his Medicare premiums will increase in 2028 by an amount he has not yet calculated and has not yet received notice of. He did nothing illegal, he did nothing reckless, he did what millions of thoughtful Americans did. He saved in an alternative asset to protect himself from a financial system he did not trust, and then he discovered that the system had been building a framework around his exit for years, methodically, quietly, and with the unhurried patience of an institution that knows it will eventually collect. The cost basis problem deserves particular emphasis because the 2026 revision to the Form 1099-B instructions added a new dimension to it. Dealers are now required to attempt to report your cost basis when they file a reporting form. That means for silver purchased from the same dealer where you are selling, the IRS may receive a cost basis figure from the dealer on the same document that reports your sale. If the dealer's records and your records do not agree, if you remember paying $22 per ounce and their system shows something different, or if no records exist at all, that discrepancy is visible to the IRS's automated matching system. A computer is reconciling those numbers daily for millions of transactions, without fatigue, without sympathy, and without any particular interest in your personal recollection of what you paid at a coin show in 2017. There is also the matter of digital payments, which a great many stackers have used with what they imagined was relative privacy. PayPal, Venmo, and eBay are now required to file Form 1099-K for transactions exceeding certain thresholds. If you have sold silver through any online marketplace, those transactions have generated forms that traveled directly to the IRS, not from a coin dealer, but from the payment platform. The IRS's automated matching system compares those forms to your return. A mismatch produces a CP 2000 notice, which is the government's formal way of saying it sees a discrepancy and would like an explanation. The explanation, if it cannot be provided satisfactorily, results in back taxes, interest, and penalties, extending 3 to 6 years into the past. The IRS is not relying on a single information stream. It has 3 running simultaneously: dealer-reported 1099-B forms, platform-reported 1099-K forms, and bank reports for large cash transactions, all feeding into the same automated engine. The notion that silver transactions occupy some zone of practical invisibility is, to put it as gently as accuracy permits, a relic of a previous era. What, then, is to be done? The answer, as is often the case with problems created by the intersection of law and inattention, is planning, and planning that precedes the sale rather than follows it. The self-directed Roth IRA is the most powerful legal instrument available to silver holders in the current environment. The IRS permits physical silver meeting a minimum fineness of 0.999 to be held within a self-directed IRA, provided it is stored with an approved custodian and depository. Inside a Roth specifically, qualified distributions in retirement are free of federal income tax. Silver that doubles in value inside a Roth IRA generates no collectibles tax, no IRMAA exposure, and no 1,099-B. The 28% rate simply does not reach inside it. This is not a loophole. It is a tool the Congress built into the code, available to almost anyone with earned income, and underutilized to a degree that is, in a word, remarkable. Timing matters as well. Spreading large silver sales across multiple tax years, rather than liquidating a substantial position in a single calendar year, can keep annual income below the thresholds that trigger higher brackets and IRMAA surcharges. For retirees with some flexibility in when they sell, this strategy requires only planning and the discipline to resist the impulse to act all at once. The step-up in basis at death is a further instrument of legal planning, specifically relevant for older holders who do not require liquidity. Silver held until death passes to heirs with a basis stepped up to fair market value at the date of death. A stacker who purchased at $18 and holds through death with silver at $66 or wherever it may be, transfers that silver to heirs who begin with a basis of $66. Their immediate sale generates no meaningful gain. A lifetime of embedded appreciation disappears, legally and permanently, at the moment of inheritance. The IRS designed this. It is the law. Use it. And above all else, above every other piece of guidance this discussion can offer, engage a certified public accountant who has actual demonstrable experience with precious metals taxation before you sell a significant position, not a tax software program. Not a general practitioner who has occasionally seen a 1099-B, a CPA with experience in the intersection of collectibles rules, bracket management, IRMAA thresholds, holding periods, inherited metal basis, and digital platform reporting. The difference between a return prepared by someone who understands these specific rules and one prepared by someone who does not is in most cases of meaningful silver positions, larger than the cost of the professional advice. The stacker who arrived at a $29,000 tax bill expecting $16,000 did not make a reckless decision. He made an uninformed one. And in a republic that asks its citizens to navigate a tax code of staggering complexity without any governmental obligation to explain it in advance, the only rational response is to acquire the information before it becomes expensive not to have it. Silver has performed. The case for holding real assets in an era of monetary uncertainty is not diminished by any of this. But real assets, as it turns out, carry real tax rules. The IRS built its framework patiently, revised it methodically in 2026, and will enforce it without drama or announcement. The citizens best positioned to protect what they have spent years building are the ones who know the rules of the game before the final whistle. Now, tell me in the comments what surprised you most about any of this. Was it the 28% collectibles rate that the financial media almost never mentions? Was it the IRMAA Medicare surcharge, arriving silently 2 years after the sale? Was it the Washington state exemption that vanished on January 1st after 40 years? Or was it the digital payment platform reporting that turned what many believed was a private transaction into a documented government record? I read every comment on this channel, and I would genuinely like to know which of these caught you unprepared, because understanding that tells me precisely what to address next. And remember, this is for education and discussion only, not personal financial advice.